Welcome back, everyone. Following the fireside chat on the vision for net zero transition, our next speakers will discuss how to put vision into action in this panel. In particular, they will talk about the demand for transition finance in the regions, hurdles to facilitate climate capital flow along the Asia-Middle East corridor, and how to scale up investment in transition activities. Speakers will also share solutions to balance financial risk and returns with effective delivery of decarbonization goals. Please welcome our moderator, Ali Izadi, Head of Asia Pacific of BloombergNEF, as well as the panelists, Justin Baldacchino, Managing Director, Supervision of Dubai Financial Services Authority, Kim Si Lim, Regional Director for East Asia and the Pacific of International Finance Corporation, Sabrin Rahman, Managing Director, Head of Sustainability for the Middle East, North Africa, and Turkey of HSBC. Emily Woodland, Managing Director, APAC Head of Sustainable and Transition Solutions of BlackRock. Ali, the floor is yours.
Good afternoon, ladies and gentlemen. Thank you very much for the kind introduction. It's my great pleasure to moderate this panel around transition finance. In the fireside chat between Eddie and Ian, we already heard a lot about the importance of scaling up transition finance. If I may, before I turn into our esteemed panelists to hear from their insights, just to set the scene for you, I thought I would share some numbers with you. At Bloomberg, we're really focused around measuring everything, because if you can't measure it, you can't improve it. So the first number I thought I would share with you is the actual investment in the real economy around energy transition. We have been tracking the numbers since 2004, and as you can see on this chart, the good news is that pretty much every year we have seen growth. And last year we hit another new record, $1.77 trillion of investment in the real economy across energy transition, from the amount of money that went in financing renewable power projects to the value of the electric vehicles sold, as well as all the other energy transition technologies that we need. So great news, 17% year-on-year growth. Now let's start look at a little bit of the challenges. If you look at it across regions, there's a wide differences between the scale of investment that's happening. China by far leads the world in energy transition investment. And last year in the US, partly due to the Inflation Reduction Act, we actually saw investments there also accelerate. EU member economies, some of them do relatively well. Once we go beyond these main markets of China, US, and Europe, the numbers are much more challenging. So even when we look at OECD members of here in Asia Pacific, such as Japan, such as South Korea, such as Australia, still the numbers are relatively low. If you look at the numbers for the global south, the numbers are far more concerning. If you look at the share of funding that has gone to the global south over the last decade, it has barely changed. And yes, there are some bright spots. We have seen, for example, the renewable market in India grow quite rapidly. But still, when we look across the entire global south, we are still seeing investment levels be too low. How low? Well, if you look at the scale that's required to put us on track for meeting the Paris Agreement goal, globally, we estimate that we need $215 trillion of investment between now and 2050 across both the energy supply side and the demand side. If you look at within this decade and compared to the amounts of investment that went into last year, in many markets that are doing well today, we're still talking about doubling the investment levels required. So if you look at China, the UK, Germany, we're talking about doubling. If you look at places like India, or for that matter, even Japan, we're talking much higher multiples. In Southeast Asia, for example, for markets such as Vietnam or Indonesia, we're now starting to get into the multiples in an order of magnitude requirements. So the scale of investment required is significant. Of course, capital markets have to play a significant role. So let's talk about the financial instruments before I turn to our panelists. On the financial instrument side, if you look at debt instruments, yes, we've seen significant growth in sustainability-linked debt instruments. You can see particularly during the pandemic, we saw a significant growth. And while there was a bit of a downturn, which we should acknowledge, we're seeing that the market is turning a corner. On transition finance, though, I'm sure you're all struggling to read the numbers on the screen. it barely shows up. We're really at the beginning. And I'm going to use this now to ask the hard questions from our great panelists here. So Kimsey, if I may start with you. The IFC, I think our audience knows the IFC very well. You work directly as part of the World Bank Group with the private sector to provide funding for infrastructure projects, and you have a lot of experience across Asia Pacific. Can you share with us what do you hear from your corporate clients? Is there demand for transition finance? What are their challenges when it comes to this sector?
Yeah, no, thanks for the question. Yes, we do see, very strong demand and as well as curiosity about transition finance. And I think there is both a strong demand as well as a strong need for transition finance in Asia. Asia has traditionally been the fastest growing region globally, and that growth has been very carbon intensive. It is still projected to be the fastest growing region globally. It is also the manufacturing hub of the world. It's the engine of the world. It produces something like 70% of the world's steel. And I think the previous panel discussed the energy mix in this region. Something like 70–80% of the energy mix in the region is fossil fuel based. So you're producing steel, which is a heavy carbon production process, with more carbon as well. So something needs to be done, and hence there is a huge need for transition and plans to transition in the region. The corporates are curious about it. They've been talking to us about plans for transition and how we can help them. And I think we as MDBs have a role to play, because traditionally, as you saw in the chart, green bonds and very project-specific type sources of sustainable financing has been flowing and has been growing, but that's at the expense of the hard-to-abate sectors, which are very carbon-intensive and therefore do not qualify for a green bond. So huge need for transition.
Thank you very much, Kimsey. Sabrin, if I may bring you to the discussion. So we heard on the Asia side, there's a lot of need, there is demand, but also challenges. Can you share with us what you hear from your clients across the Middle East?
Sure. Hi, everyone. In case you are wondering, yes, I'm trying to blend into the background. That's why I wore the suit. I think this is a fantastic and really timely discussion about the corridor piece, which in the last panel, they really brought to life. What we're hearing from investors and clients is that they want a change in narrative. They want a change in the position. They want a change in definitions, and they need that support. So the Middle East is home to some of the largest sovereign wealth funds in the world. They are invested in diversification agendas. So if you look at the UAE, you look at Saudi, diversification is a matter of national security and growth. But what they also want to do is ensure that that diversification and that flow of finance is really to regions that understand their priorities, maybe reflect culturally a lot of the challenges that are faced as well, and really work collaboratively. So some of the things that we think are incredibly important is really to talk about trade. So for example, Premier Lee was in Saudi and the UAE just last week to really kickstart, again, the free trade agreement talks that have been happening over the last 20 years almost, but now there's that real momentum behind it. And there's a real want and a willingness to really match the liquidity in the Middle East with the technological know-how and the industrial capacity of Asia. If we can really match that, I think we will see a really powerful alliance, which will be the gateway to not only Africa, other parts of the Middle East and parts of Asia, but I think in terms of just the know-how and the diplomatic power as well that brings, I think that can really change many things. So HSBC has been doing an enormous amount of work in the Middle East. Prior to even the COP28 presidency, we're one of the leading banks on sustainable finance, really working on supporting our regulators with defining taxonomies to really ensure that we have the same vocabulary when we are working across borders. It is a lot more nascent within our region than perhaps others, but what we see is incredible willingness from the government and at the highest level, which makes our work much more much easier. I'd also like to bring up the fact that Ian had mentioned the DIFC free zone, but we also have other free zones across the UAE which focus on industrialization. So, for example, in the last year, we've seen a 25% increase of Chinese companies setting up base in the UAE. So all of these things actually are really strong indicators that this corridor will grow. Middle Eastern investors care about this transition, and they're willing to put funds where it matters.
Thank you very much, Sabrin. Justin, if I may bring you into the discussion. So we just heard a very positive outlook for the real economy around collaboration between the two regions. And earlier, Ian also touched upon the growth of ESG sukuks in the region, specifically around transition finance, if I may, so giving you more the challenging part of the question. How do you see demand in the region? Are there opportunities to sort of combining, we heard from Sabrin around combining the technology from China with the capital from the Middle East? Is there a specific role that transition finance can play there?
I guess from our perspective, we're definitely seeing the opportunities. And so when you say around demand, it's very hard to quantify, what is good and bad demand, but we're definitely seeing the opportunities flow through. And there's plenty of examples where we're seeing the transition finance taking place from, we're seeing specific sustainable linked bonds, and also from sustainable linked loans as well, where there's specific requirements. And as part of those requirements, from the good purview that we see is that we've got almost 800 firms that we can get a good idea about, and they're all at different stages of that journey. So for us, it's a good way that when we are speaking to the firms, doing our risk assessments, determining our thematic reviews, understanding what sort of requirements we should have going forward for that journey, is to sort of enable that. I think that the main challenge we have, and what's going to determine what the demand looks like going forward, is for us to play more of a role as part of that process. And what I mean about that is ensuring that we actually have the knowledge share taking place. As Ian said, there's a number of initiatives, not only across the UAE, but specifically within the DIFC, where we're able to leverage those capabilities going forward, and also working with the big banks that we have within the DIFC to actually ask the question around what is it that their clients are actually asking for. Now there's certain aspects where a client might ask for a decrease in regards to the interest charged or the capital that's being held by the individual institution. They're things that we can definitely work through, but I think more importantly, what I've heard throughout the day is more around the fact that we need to remain consistent, and we need to also be aware that everyone is at a different stage of that journey as well. And what I mean by that is when we see some of the banks, they're well ahead of the curve in relation to what they're doing in this space. But when we look at the smaller markets or the small institutions, the SME driven, we have to make sure we take a very balanced approach, but also a very consistent approach. So across the UAE, we have a number of regulators and government authorities that are also trying to make sure that we're coordinated, and it's mainly around making sure that we can deliver what we promise to deliver and make sure that's consistent across what we see from a UAE and also China corridor as well. There's definitely opportunities, and we've got plenty of case studies where they actually have worked, and they're actually taking the next step to make sure they expand on the good work that they've done. But of course, from a regulatory perspective, we have to play a big part in that as well.
Thank you very much. Emily, if I may bring you into the discussion. We already heard, yes, there's demand, but there are specific challenges around markets, technologies, client type. From your view, you are with one of the largest asset managers in the world. Where do you see demand today for transition finance?
Thank you. So I'll just set the scene by sort of saying our role as a fiduciary is to identify risks and opportunities that impact our clients' portfolios over the long term. So they're really looking to us for help on how to identify these big structural shifts in the economy that might impact their portfolio outcomes. And we see the low carbon transition, I'm probably preaching to the choir with this audience, but we see the low carbon transition as one of 5 big megatrends that are going to be reshaping our economy for decades to come. We're talking about a full-scale rewiring of an economy that took over 200 years to build, and we're trying to do it in 30 to 50 years. So obviously, that's going to take a lot of capital, not just into the energy system, but into the supply chains, the transportation, and everything else that goes around it. So by our own estimates, just the energy system alone is going to need $4 trillion of capital per year from now until 2050. And then once you start bolting in everything else around it in the real economy, you get to numbers closer to the $9 trillion number we heard in the previous session. Now, that's double where we're at right now. And we think Asia is going to be about half of that by 2050. So really, the transition's very much front and center in terms of our clients know this opportunity, they see this opportunity. Around 70% of our top tier clients globally have got some sort of climate commitment. Now, that might be a net zero by 2050 commitment, it might be just a simple emissions reduction target, it might be they want to allocate into specific climate solutions, and that's really important. But there are obviously a lot of different ways for them to access that. That can be everything from public equity and fixed income to private equity and infrastructure. We see infrastructure as probably the fastest growing segment of that, and that's driven by supportive government policies around the world. It's also driven by a renewing global focus on energy security, which we can't ignore. But also clients are looking to add infrastructure to their portfolios because of its unique characteristics like low correlation, low volatility, and strong yields. So we've been investing equity into transition projects, and I'll keep my observations to APAC for now, but in OECD Asia, we've been investing into transition projects across Japan, South Korea, Taiwan, Australia, New Zealand, and in EM Asia, we've also been partnering with developers building out solar capacity in Malaysia, the Philippines, and Thailand. So and actually, I don't think there's a shortage of capital to invest in transition projects, particularly sort of, the greener end of the spectrum in developed markets. But I think where they're still not kind of confident in deploying money at the scale it needs to go is in emerging markets. And if you think that EM, ex-China and Russia is going to be around half of global emissions by 2050, there's obviously a really big gap here that we need to try and fill. And the problem is that the risk tolerances of large global asset owners, essentially our clients, they've not really been built to allocate to emerging markets at scale. So, they've got allocation policies that focus on certain markets or sectors, and so their own risk return expectations have been built, around kind of that of the US or EMEA, for example. And so if you want to get capital to come into emerging markets at scale, some of the risks that are holding them back would be things like low access to domestic savings in these markets, or high sovereign risks, or shallow domestic capital markets, or currency convertibility risk, or lack of bankable projects. And so you've actually really got to think about how we might package these risks differently in EM, and so that we can channel the capital needed. We've really got to think about increasing amounts of innovation, increasing amounts of structuring, and partnerships across multiple different participants in the ecosystem. And maybe I'll come back to some of that a bit later.
Thank you very much. If I may ask you a follow-up question, just to make sure I understood, the challenges that you listed, a lot of them are way beyond just simply having a category for transition finance. Is that fair to say? So if I'm understanding correctly, what you're pointing out is that before we even get into discussing whether somebody would want to buy a transition bond or provide funding to a transition, provide equity to a transition project, we should first look at where the funding is needed. And when we look at those emerging markets, there's a lot of macroeconomic structural challenges to begin with that we need to address before we even talk about the financial instrument. Is that fair?
No, that's absolutely fair. But what I will say is I'm seeing a sort of, particularly since COP28, there's a renewed energy of focus to try and solve for some of those challenges. So I think there's now a lot more motivation than there ever was before in order to invest in the transition and overcome those barriers.
Thank you. Kimsey, if I may bring you back in, so looking at some of the challenges that Emily just listed, World Bank Group from the beginning has been focused on addressing some of these challenges, and within IFC in particular, you're looking at bringing private sector from other mature economies to support the emerging market transition. how much progress have you seen, and where do you see really the barriers to get to the next stage, to that doubling and the quadrupling that Emily just cited?
Yeah, so we've been doing exactly what you said, Ali, bringing the partners from developed markets into emerging markets, holding their hands and helping them, get comfortable with the emerging market risks. But we've so far really focused on what we said, the project by project. So it's a green bond, it's a blue bond, it's a social bond, and so on. And I think that's good progress, but it's not really going to move the needle on transition. If we were to do it one project at a time, I think we will run out of time. And Asia, I think is a place where we really need to scale up. There was some articles that I was reading that said that Asia would exhaust the world's carbon budget by 2040 in a business as usual scenario. So what we are trying to do now is to develop along the lines of the ICMA principles, a transition bond framework, transition finance framework. It's very, very early stages. And what it requires is for the entity to commit to a pathway, a science-based pathway to net zero by 2050. It has its challenges, and I can go into that if you want, or I can park it there and say, because your question was about.
Yes, no, but this is great. If I may then just directly ask you, so for green bonds, for example, we've had a lot of challenges around use of proceeds, and how do you measure and verify that? When it comes to brown to green, that's even harder. And I know we have a representative from ICMA here as well, and I think many members of ICMA actually asked ICMA to consider developing a transition bond as a terminology and a taxonomy, and that debate, I think, is still continuing. But from the IFC perspective, how would you define that, actually? How would you?
Yes, I think that's work in progress. We're working with ICMA on that, and we're hoping to leverage the experience that we've had in launching blue bonds and social bonds. So we developed our own blue bond framework in 2021, 2022, and since then gone on to issue about 2 billion of blue bonds globally. Of course, there were, learnings from there that we can apply as we roll out the transition finance principles and frameworks. It is much, much harder given the tenor that's involved. As I said, the entity needs to commit to a net zero, science-based net zero pathway by 2050. That 25-year term is beyond the term of any company's business plans, even the CEO's term. And even for lenders, even as MDBs, we rarely provide loans of that tenor. So how does one, report back and review the progress? What leverage does the lender have beyond the tenor of the loan or the bond, or that whatever the engagement is? I think that number one is one of the biggest challenges. I think the previous panel talked about greenwashing risk. This is the biggest risk. Secondly is the cost, especially in the brown to green sectors. Asia has one of the youngest fleet of coal power plants. I think the average age is about 15 years. In Europe, that's about 35 years. How does one take out the coal from the system at a cost-effective way? And who's going to fund that? So I think these are some of the issues that one has to work through. And whether we take it in bite sizes, is one idea, as opposed to a big bang to 2050. Maybe we do it in tranches, but that's all really work in progress.
Thank you very much. Justin, if I may bring you back in, Kimsey just touched upon greenwashing. In the earlier panel, Ian made a very clear argument that, well, the way to deal with greenwashing from the regulator's perspective is just another market enforcement issue. Would that be the same if you're talking about transition finance, given the challenges that Kimsey just decided?
I think it'll definitely still be the same on the basis that if you think about it from a regulatory perspective, they've still got to have the right governance, the right detail that's provided around the transparency and what they're actually doing and how they're doing it as well. The challenge we have with all firms is making sure that whatever is outlined to their investors is consistent with what's actually documented as well, and what's happening in practice. The disconnect is always what's happening in practice, because sometimes it's articulated well, whether it's in a perspective or in anything else, but it's not actually in practice. When you actually do your reviews, in practice, it's just not happening at all. So for us, it's about understanding, what are those challenges, trying to work together, but also seeing it at the next level. So we're seeing a lot of the international standard setters, articulate what is best practice, and it's about us determining how we can fit that into a process that we have from a regulatory perspective. And we've seen that also, I think, at the Basel Committee level, where now, as part of their set standards in regards to Basel core principles, you've got the sustainability finance, where it needs to be part of your supervision approach going forward as well. So we've embedded that into our process. Of course, we're not going to be restrictive and try to, to the point made earlier, we don't want to restrict the industry itself, but what we want to do is we want to try and enable it going forward as well. So it's about trying to pick points on what we're seeing at the international level, but make it more locally driven, as was articulated within what was discussed by Ian earlier. So for us, it's about really choosing the right information at the right time, but also being realistic of what's actually achievable as well going forward. Thanks.
Thank you very much. Sabrin, if I may bring you back in. So we heard already the scale of demand needed, the potential for new taxonomies. It'd be very interesting to see what the IFC and ICMA come out with. As a commercial bank, would you like to have a taxonomy around transition finance?
Tough one, and this is being broadcast, right? So, look, I think...
You can express your personal opinion.
So look, I think anything that allows us to speak from the same hymn sheet is always appreciated. But in the development of that, all voices must be equal. And the reason why I say that is because too often transition is often seen from a certain lens, which may not be applicable to all markets. So the development of it has to be democratic. Therefore, then the application will be democratic and widely used. So I know it's a non-answer, but I think that we need to do better as a global community to really tackle these sticky topics. And this is why it has taken so long to get there, or we're still in progress. It's one of the things that I saw debated in and out of COP28 amongst climate negotiators, right? Everybody has to look after their sovereign interests. We understand that, right? But it's also, everyone does need to transition, corporates, governments, and so forth. And all of the new NDC commitments that have been made by countries, the UAE is just submitting their 3.0 version. They need to have credible investment plans behind it. Otherwise, they can't transition. So we have an enormous opportunity in terms of transition finance to work hand in hand with national governments and with the UNFCCC, because now everybody is really welcome at the table, which wasn't the case perhaps before. The investment community, the financial community, the private sector are very, very critical linchpins of delivering any commitment that the governments have made at the highest level. So I think transition is a key part of that, right? We need to define it, and we need to ensure it's just and inclusive as well.
Thank you very much. Emily, if I may bring you back in. So in the earlier round, you listed a lot of different challenges that we face, and we heard a little bit some elements of how we could overcome those. If you could please share your view around how could we overcome the challenges that you listed earlier, what type of collaboration between the private sector, regulators, and the civil society can happen to overcome those challenges that you listed earlier?
Yeah, thank you. So I want to come back to some points that Eddie made in his opening remarks, as well as some very valid points that Kim C made. So it's in essence, when we're trying to deal with really complex challenges like venturing into the transition in new uncharted geographies or into new technologies that are going to, for example, decarbonize the hard-to-abate sectors, we need to try and get away from this kind of transaction-by-transaction approach that you mentioned, Kim C, because we're just not going to get the scale that we need in the time frame that we need. So public-private partnerships are going to be really, really critical to scaling investments in transition finance. And that's both in kind of, emerging markets, but also emerging technologies. And so for us, we believe that larger scale kind of blended finance platforms can be really integral to that in terms of having the potential to allocate risks, both in new technologies and new markets, more efficiently, and helping clients to kind of access these new untapped investment opportunities in these places. But, there isn't just kind of one solution. There's no one-size-fits-all solution. It really is going to take a village of solutions. You need to be able to convene the whole ecosystem, and that means kind of leveraging the respective skills, capabilities, balance sheets of everyone that can come to the table. So I thought it might be useful just to share a couple of places where we as a firm have been leaning in, because this is really strategically important to us as a firm. So where we started on this journey was our inaugural blended finance platform, which is the Climate Finance Partnership. Now, this was announced at the One Planet Summit in 2018, and it's essentially a blended finance fund that brought together catalytic capital from 6 different governments and philanthropic bodies. So the governments included the government of France, Germany, and Japan, and then we also had some philanthropies in there. They kind of brought first loss kind of junior equity to the table to the tune of about $131 million, and then that managed to crowd in another 16 global institutional investors, many of whom were from this region, about another 542 million. So in total, 673 million. So for every $1 of catalytic capital we received, we mobilized over $4 of private institutional capital. And that's currently deploying into infrastructure assets across LATAM, Sub-Saharan Africa, and Southeast Asia. So the solar transactions that I mentioned earlier were funded by CFP. We've continued kind of along this journey in various types of public-private partnerships. It would be remiss of me in this audience not to mention the second one, which was at COP28. The UAE announced its climate finance platform, Altera, which is a $30 billion venture allocating across both DM and EM transition strategies. So we partnered with them on $2 billion of that. And what's really interesting is that's allocating in transition opportunities across the asset class stack, so debt and equity, as well as I said, DM and EM, and it included $250 million of catalytic capital that'll be announced to a strategy that we'll be announcing soon. And then 5 months ago, we also announced a partnership with the Insurance Development Forum, which is a World Bank-backed group of leading insurers to develop a blueprint that'll facilitate investments into climate-resilient infrastructure in ways that will actually be more suitable for institutional insurance investment clients. So it's something that we continue to invest in as a firm, and I think, looking at new technologies, particularly hard-to-abate sectors, industrial decarbonisation is something that's very much on the radar, but, leveraging our position in the market to be able to convene all of those different industry players will be really, really critical to that.
Thank you very much. Those were excellent examples, positive examples. On my side, we've been following the Just Energy Transition partnerships that were announced with a lot of fanfare, but unfortunately those public-private ones still seem to be a little bit challenged. But it's great to see that we are actually seeing movements in some cases where they're working. There were a couple of questions from the audience, so I'm going to blend them into our final round of questions. One, we've already talked a bit about the role of transition finance, particularly in the power sector. So we talked about the renewable projects that are already in many places economical, but also the need for phasing out coal, particularly here in Asia. Beyond the power sector, and this is an open question to any of the panelists, maybe Sabrin, I'll start with you actually. Where do you see opportunities for funding that will help with climate change mitigation? So beyond looking at the power sector, are there other projects that, as a bank, you're looking at helping your clients?
Look, I think for us, it's really having a sectoral approach, right? So yes, beyond the power and utility sector, agriculture is a massive area, as well as infrastructure. I think it's really about materiality, but making it very region and sector specific. So there are, we're also, I might as well put it in there, but we're also founding members of an initiative that was launched by the COP28 presidency, which is the Global Center for Sustainable Finance. And that platform, which BlackRock are also a founding member of, is really about changing the narrative, the dialogue, and the flow of finances from developed to emerging nations, but also to look at really critical topics such as carbon markets integrity and so forth. So For us, it's about, yes, absolutely supporting our clients in the transition through a focus on sectoral needs, but also to help build public goods and that ecosystem of support that's required.
Thank you very much. So for our final round, I'm going to give you each just over a minute to share your view, given that HKMA and DFSA have done a wonderful job of bringing a unique group of stakeholders around transition in the room today. What would be your recommendation for us going forward around scaling up the collaboration? As you heard earlier from Ian and Eddie, we're going to try to do the research around how we can scale up transition finance, particularly in terms of taking advantage of the opportunities around collaborations between Hong Kong and Dubai. But what would you like this audience to go away with thinking about to help us increase transition finance? Maybe Kimsey, if I may start with you, since we started with you.
Yeah, I think you mentioned it, Ali. The word is collaboration and partnerships. I think it starts with the public and private partnerships in terms of identifying the projects. You asked about sectors. I think transport is a big one. Public transportation is typically provided by the government, but the private sector could come in and develop new technologies for making better battery solutions for the electric buses or trains or whatever mode of transport we're talking about. And the hard-to-abate sectors, I think, is another one. These are typically state-owned entities as well that operate these large industrial plants. So again, it's a public and private partnership and willingness to commit to net zero and to have that pathway to decarbonize. Then it's the taxonomies. Again, it's collaboration across the different regulators, across the different jurisdictions to make sure that the taxonomies are harmonized and clear in order to hold the stakeholders accountable and in order for the investors to be clear about what they're investing in, whether it's local or whether it's global. Right? So I think it's everybody needs to step up. I think Eddie said it very, very clearly. Nobody can do this on their own.
Thank you very much.
I think from my perspective, it's about just prioritising the initiatives themselves. So the positive thing that I've seen is a lot of the firms have actually allocated a lot of resource to their initiatives, and the resources themselves have been significant in regards to the scale of resource, but not only the scale of resource, but where those resources sit. And what I mean by that is a lot of them, you have chief sustainability officers that are now sitting on EXCO and presenting to their boards and presenting these initiatives to their boards as well, and around the fact that trying to get the accountability, trying to make sure they get the delivery. So for us, that's extremely positive, and we just want to see that momentum going forward.
Sabrin?
Look, I think there's a few things that I'm going to bring up, so it's going to be a bit longer than. But for us, what we would definitely see is really a focus on dialogue and collaboration across the corridor, only because what we're seeing is that often these things aren't captured. So earlier this morning we spoke about case studies, but really practical things. So HSBC's joint venture with Temasek, which is called Pentagreen, is really about allocating capital and finding investors for infrastructure projects across Asia that would otherwise not be funded. We're also really leaning into supporting entrepreneurs really from seed to scale. We've launched a $1 billion climate tech fund really focusing on the new economy. So I think where institutions have a huge amount of influence is doing practical things, documenting it, seeing what works, what doesn't, what needs to pivot, and really feeding that into the ecosystem so we can all co-learn and co-grow.
Thank you very much. Emily, you get the last word.
Thank you. Well, I guess I already talked about partnerships, which I'll stand behind, but I'll cheat and offer a second one. Look, at the end of the day, the types of investments that we're talking about here, our clients are long-term investors in nature. And these types of investments, they're multi-year, even multi-decade in certain cases. And so regulatory certainty is a really, really important driver of the risk premium by which clients assess these projects. And so in order for them to have confidence in where they're actually channeling their capital, I think, any certainty that they can have around both the real economy, regulatory and policy environment, but also how things are defined and labeled will be absolutely critical to how investors are making capital allocation decisions over the long term.
Thank you very much. So if I may very briefly summarize, we need collaboration and sharing around case studies that can allow us to both learn about the different technologies and what policies work, more importantly, ensure that we have policy certainty, but also improve clarity around taxonomies. Please join me in thanking our panelists.